Hey everyone, last week the Federal Reserve met and no surprise here, they didn't change the overnight rate. They also didn't change their position on quantitative tightening. They're still letting $25 billion of long-term treasuries and securities burn off their balance sheet each month. During the press conference, Chairman Powell reiterated the Fed's belief that current rates are sufficiently restrictive and they're not ready to lower rates further at this time. Reading between the lines, the Fed's waiting for policy and fiscal plan details from the President and Congress before they make their next move. The press corps asked several questions about tariffs and immigration and President Trump's demand for lower rates, but Chairman Powell deflected all of those inquiries. So, as expected, no rate cuts in January, and we'll have to see what happens at their next meeting on March 19th. But Wall Street is leaning heavily toward no rate cuts at that meeting either. At this point, according to FedWatch, there's about a 45% chance of a rate cut in May and a 70% chance there will be at least one rate cut by the Fed's June 18th meeting. As those of you who joined the Millichap webcast with Moody's chief economist Mark Zandi on January 23rd know, he believes the 10-year Treasury will likely remain in the 4.5% range this year. If you missed the webcast, the replay is available on our website, marcusmillichap.com, in the events section. And that brings me to what I heard about interest rates at the National Multifamily Housing Council conference last week. I think there were close to 10,000 people from across the industry at the event, and I had the opportunity to meet with numerous investors. And the consensus opinion I picked up was that investors are finally coming to terms with the new interest rate climate. Over the last couple years, investors have been holding back, waiting for interest rates to fall. But it appears sentiment has shifted and investors are acknowledging that there's a low probability the 10-year Treasury will fall to 4% this year. And based on what I heard, investors are adapting their strategies to accommodate a higher interest rate climate. Numerous clients told me that their activity has been constrained over the last 2 years, but they plan to be more aggressive in 2025. Some said they plan to sell assets where their capital is tied up and the properties simply aren't performing to their expectations. They indicated that they decided to move that capital into new properties with higher growth potential. Other investors indicated they have significant dry powder capital ready to go and they plan to increase their pace of acquisitions this year. So basically, it appears that many apartment investors have come to terms with the new interest rate climate and they're ready to get active. Granted, this conference was predominantly attended by apartment investors, but I think the sentiment expressed regarding interest rates extends beyond just that one property type. We've seen upticks in both the Small Business Optimism Index as well as consumer sentiment over the last couple months, and the lender survey suggests that commercial real estate lending is at least stable, if not improving. The lenders I spoke with at the conference indicated that there's plentiful debt capital available for commercial real estate and that lender spreads have been coming in. So while many believe the underlying rates like the 10-year Treasury will be range-bound this year, the rates charged by lenders may come down a bit. Borrowing rates on multifamily properties are currently in the low 6% range, but of course that depends on the strength of the buyer, the asset quality, the asset location, the terms of the loan, how much leverage is used, and so on. Borrowing rates on other commercial property types are running a bit higher, somewhere in the low to mid 6% range. And at those rates, many of the assets being targeted by investors may face negative leverage with going in cap rates below the cost of debt capital. In the fourth quarter, the national average cap rate on apartment properties priced over $15 million was about 5.5%. So if an investor gets a loan at 6%, it may be difficult for the investor to generate positive cash flow over the short term, depending on how much capital they put down. That said, several investors indicated short-term negative leverage would be okay as long as they could see a path to increasing profitability. To me, this sounds a lot like how real estate investing used to be. where investors find assets with upside potential, where they roll up their sleeves and create value through upgrades, better management, or some other strategy. And in my opinion, that'll be good for the industry. So, while investors probably won't benefit from ultra low interest rates in 2025, it appears they plan to capitalize on other opportunities. Potentially lower taxes, the prospect of a strengthening economy, accelerating household formation, and good old-fashioned value creation. There are a range of potentially beneficial tailwinds emerging. It'll take time for them to fully form, but I think investors are getting into position to catch the winds of opportunity. The investors doing that today clearly have their eyes on the horizon.